All right, so our next chapter is over non-current assets. We've spent some time talking about cash and internal control, um, receivables. We just covered that. Inventory. All of these things are the major current assets. So now let's look at some assets that are non-current. And we have a list here, and we're going to go through all of these. But we want to understand what the criteria for classifying an asset as non-current actually is. So if a current asset, if we expect to convert that into cash or into more cash within 1 year or the operating cycle, whichever is longer, well then non-current assets have the ability to generate revenue beyond 1 year or beyond the operating cycle for whatever business we're talking about. So again, land, business, buildings, equipment, intangible assets, we'll talk about that, and natural resources are all example of non-current assets. So when we talk about land and the purchase of land, there are a couple things that we need to understand. Most of what your slide here are all of the things that we're going to include in the price of land. But right up here is a very, very important bit of information. And it says land is a non-depreciable asset. And the reason for that is that it is generally assumed that the land that you are purchasing today is in the same condition it was 100 years ago and 100 years before that. And so it's really not an asset that can be depreciated. So when we talk about calculating the price of the land, we want to include any and all one-time expenses associated with the purchase of the land. So obviously we've got the purchase price. We're not going to pay real estate commissions except for perhaps when we've purchased the land initially, so we can include that. Title insurance premiums. Now these are insurance premiums on the title to the land, they're not insurance premiums on the land. So only title insurance premiums that you would pay one time would be included. Delinquent taxes, property taxes that you pay on an annual basis are not going to be added to the basis of the land. But if you purchase land and the owner that you purchased it from has not paid property taxes, and you have to pay that, well then you can roll that into the cost of the land. Raising costs of a building on the land, that just means if we have an old barn that's long ago should have been removed, and we're going to do that now so that we can use the land for our purposes. We actually include those costs in the land. And then title and legal fees. Okay, so all of these are costs that can be added to the basis. Well, they are added to the basis of land, and then again, land is not depreciated. We're going to talk about depreciation and exactly what that means here in a moment. Okay, so we just have a basic journal entry here. We have discussed the purchase of land. I believe it was way back when we were talking about the accounting equation. And this is another pretty good example. This is just a journal entry for a company that has purchased land for the $250,000. And we don't know exactly what they paid, but all-in cost is $250,000. So land as an asset has gone up $250,000 with the debit. Cash has gone down $250,000 with a credit. And so the impact on owner's equity, in case you were wondering, would be nothing. Now we have a situation where 5 years later that same piece of land is sold for $300,000. And we have a journal entry here. We got cash of $300,000, so that asset went up. The land was only on the book for $250,000. It went down because we no longer have it. The difference is a gain on the sale of land. We could have just as easily, if we had sold the land for $200,000, we would have a debit to cash for 200, a credit to land for the same 250, and we would have a loss, which would be a debit, okay, for the 50,000. But in this particular case, looks like we made money, so that's always a good thing. All right, so we need to discuss this concept of basket purchases, and we can use basket purchases for any number of business transactions. The example that you have here on your slide is a situation where we purchase some type of commercial property, and of course there's going to be some land that comes with it usually, and so we have to kind of allocate the total cost, whatever it is we've paid for the item, to each item that we purchased. So when we do this, we're going to look at two things. We're going to look at the amount that we paid, but we're also going to allocate based on relative market values. So it says here on January the 1st, this company, Upco, purchased land and building for $200,000 cash. All right, so that's what they paid for it, for these two items, the land and the building. And so between the two of these items, we can only put those on the balance sheet for a grand total of $200,000 because that's what we gave up in cash. However, it says the appraised values are building $162,500 and land $87,500. The question says how much of the $200,000 purchase price will be charged to the building and land accounts. So what we do here is we just say, okay, we're going to add these two figures. Appraised value 87.5 and 162.5 is our 250. And then if we were going to divide 87.5 over 250, that would give us a decimal of 35%. And with the land, we'd have a decimal of 65%. We take that percentage, 35% allocated to the land, multiply it by our actual purchase price. And so we're going to put the land on the books at $70,000, the building on the books at 65% of the purchase price. That's going to total $130,000. Okay, so we paid $200,000. We allocate accordingly based upon the historical cost principle. We can use these percentages over here for appraised value to come up with our allocation percentages, but in no way should we end up with $250,000 on our balance sheet. I want to go back real quick to this basket purchase. Land and building is a pretty common example, but we'll see this oftentimes whenever a business is purchased. If we go in and we purchase a business, we have to establish the values for each of those items, and we won't always get a discount. So later on, we're going to deal with kind of this same concept, but when instead of having something that's worth $250,000 and we pay $200,000 for it, we may have something that's worth $200,000 and we pay much more for it. Okay, so we can use this basket purchase with any number of assets, not just land and buildings. So when it comes to buildings and equipment, same story is true as for land, except for a couple of items. It says all costs incurred to get an asset ready for use are capitalized. So when we say the word capitalized, what do we mean by that? We just mean that this is going to be an asset that is placed on the balance sheet, and we are going to depreciate this item over the asset's useful life. Now, we don't do that with land. We put land on the balance sheet, but then we don't touch it. So kind of the same story here. Any fees that are one-time costs, okay, Whenever we purchase it, we obviously have the purchase price. With a vehicle, not necessarily with a building, we might have transportation costs associated with getting it to us. Any installation cost, let's say that there's a lot of snow in the upper Midwest. Maybe we install some extra equipment to account for that. Any cost of permits associated with, say, building a building or a set of buildings from the ground up. These are all one-time expenses, and so they would be added to the cost of the asset. All right, so depreciation. A couple things I want you to understand here, but let's read through it. It says depreciation is the allocation of the cost of an asset to the years in which the benefits of the asset are expected to be received. It is an application of the matching concept. So if we buy a building for $100,000 and we're planning on using that building for an indefinite period of time, but for, say, decades, well, we're not going to expense that item just because we had a cash outlay of, say, $100,000 or $200,000, whatever the amount is. We're not going to expense that all at once. We're going to say, okay, there's some rules for this. We think we're going to use this building for 20 years, 30 years, so on. And so we're going to take that expense, and depreciation is an expense. It is a non-cash expense. We're going to take that over time. So let's look at how we do this. On the balance sheet, we're going to put the acquisition cost. We've looked at an example for land and buildings. I think we had a building for $130,000 and some land at $70,000. Those are the amounts that would go onto the balance sheet. Okay, now the difference is the land is at $70,000 is just going to be $70,000 forever. The building, however, is the cost of that building is going to be allocated through depreciation expense, and it's going to show up on the income statement as a reduction. It's going to be in the operating expenses portion of the income statement, and it's ultimately going to reduce our net income. So I want you to also note this very important sentence here. Says they're talking about depreciation. Depreciation does not reflect decline in value. And that's really true. I want you to understand, if you build a building for, we used the example $100,000, and you use it for 20 years, at the end of 20 years, even if that building is not in the condition it once was, but it's still a good solid building, after 20 years, it's probably not worth $100,000. It's probably worth a whole lot more, not less than $100,000, because some assets appreciate in value. So what we are talking about when we talk about depreciation is a system of cost allocation. Very, very important, these two words, cost allocation. All right. Does not necessarily reflect a decline in value. Why am I putting so much emphasis on this? Because the way that you have been introduced to this word depreciation is largely incorrect. The layman's use of this term and the way that we're using it, they are different. So here we have an entry to record this depreciation expense. Now I want to go back to that building that we had on the books for $130,000, and let's just say that was our only depreciable asset. We had land in the building, and land's not depreciable. So look at the journal entry. We have depreciation expense for so much. Let's say it was $130,000. We were going to have the let's just see here. Let's just say that we had a $130,000 building, and let's just say that $120,000 of that was depreciable. for 20 years gives us $6,000 per year. We might have depreciation expense of $6,000 here, and then accumulated depreciation would be our credit. This is a contra asset. This is an adjustment account on the balance sheet. That would be $6,000. But notice nowhere here do you see the term building. Okay, so the building is still on the balance sheet for $130,000, but accumulated depreciation is now also on the balance sheet as a credit amount for $6,000. So, and we'll get to this, we had $130,000. Now I only depreciated $120,000. I'll get into the reasons why, and perhaps a building's not the best example to use. But we have the building on the balance sheet for $130,000. We have accumulated depreciation on the balance sheet for $6,000 as a credit. And so we would say our net asset value for that particular asset is $124,000. But we're always going to show that building at that $130,000 that we put it on there for initially on the balance sheet. Okay, so keeping with the concept of depreciation, our balance sheet presentation looks like we've got a building and we've got a truck here. We're going to show the building at in this case, it's $100,000. Less accumulated depreciation gives us net book value of $85,000 for the building. And then we have a truck we purchased for $25,000. It has accumulated depreciation of $10,000. Net book value for the truck, $15,000. Total net book value is going to be $100,000. When it comes to depreciation, we want to understand that depreciation expense is, it says depreciation for the current year, and that's probably the best way to think about it for our purposes. So depreciation expense is a yearly item, monthly, yearly, however you want to think about it, and it shows up on the income statement. Accumulated depreciation doesn't have anything at all to do with the income statement, and it is total depreciation recorded as of the balance sheet date. So let's go back to our example. We were talking about $130,000 asset that was depreciated for $6,000 a year. Well, whether we're talking about, I think it was $120,000 base divided by 20, this $6,000 is going to be our depreciation expense for that asset for every single year. So if I ask you after year 3, what is the depreciation expense? It's $6,000. However, if I asked you what is accumulated depreciation after the first full 3 years, it would be $18,000. So, key difference between those two: depreciation expense is only for the current year. Accumulated depreciation is for the life of the asset. A moment ago, I talked about an asset that was $130,000, and I said that we were only going to depreciate $120,000 of it. And the reason is we're going to be studying the straight line method in this course. Now, your textbook will talk about the double declining balance, and quite honestly, we just don't have time to get into that. And so we're going to only use the straight line method in this course. So we say that annual depreciation expense, the amount that's going to be expensed on the income statement, is equal to the cost of the item minus the estimated salvage value. So a building is not going to probably have a salvage value. If you paid $130,000 for it, it's not going to have a salvage value of $10,000. And that's why I kind of said briefly that a building may not be a very good example. But we're going to use it anyway, because the $130,000 could be for a piece of expensive machinery or whatever. So let's just say that we had a piece of machinery that did cost us $130,000. That would be our cost. Let's also say that we estimate that when we're done with this piece of equipment, we think it's going to last us about 5 years, that we're only going to be able to sell it for about $10,000, essentially scrap. That $10,000 we're going to subtract out. So that would give us, bear with me one moment, that would give us $130,000 minus $10,000 salvage value equals $120,000 depreciable base. Now let's say that our estimated useful life was 5 years. We would merely divide that by 5, and we would come up with a $24,000 per year depreciation expense. So let's say here, well, they actually gave us some different numbers here. They purchased the equipment for $50,000. Equipment has an estimated useful life of 5 years and an estimated salvage value of $5,000. So we'll use their example. $50,000 minus the $5,000 salvage value divided by the same 5 years. Annual depreciation expense is $9,000. So there you go. That was a little bit of a bonus. You got my example and you got their example. And again, this is using the straight line method. Notice this is a little schedule here, and this will be our last slide. This video is getting a little bit long. We purchased the asset for the $50,000, but our depreciable base is $45,000. So our yearly depreciation expense is $9,000 as a debit, because expenses are a debit on the income statement. Our annual accumulated depreciation is credited to the balance sheet of $9,000, but look what happens on year 2, 3, 4, and 5. And notice it also says that depreciation stops when net book value equals salvage value. So we paid $50,000, but we're only going to depreciate $45,000. We're going to stop at salvage value. Okay, let's go ahead and wrap this video up, and then we'll pick up with another one and get through the rest of this chapter.